Hello and good morning. Thank you very much for taking the time out of your day to be here. I've spoke at a few of these events, but for those who don't know me, my name is Steve Bennett. I've been with Charter Hall now for almost 10 years, and I have the pleasure of being the MC for today. And given this is a Charter Hall property event, I do want to stress a few things. So at Charter Hall, we very much believe in education is the key to everything we do. Nothing we say today should be taken as financial advice. We're very much about, if you understand the different ways you can access property investments, do your research, look at different managers, speak to your advisor, and if this is a particular sector, I encourage you to consider it. Then I've got three experienced property fund managers to talk through how a listed property vehicle works. You'll hear from our CFO, Russell Prout, around how Charter Hall manages its portfolios, the importance of income stability, length of lease term, covenant strength, and the growth that we've been able to deliver for our investors over a long period of time. And then finally, I'll touch on the unlisted property sector. So the unlisted is something I've been involved with now for over 15 years, prior to Charter Hall at Macquarie Bank. And it's something that I'm very passionate about because I believe that the characteristics of unlisted property deliver what investors are really looking for in this low income yield environment. And that is growing, regular, sustainable income streams. So I've had a few questions around before today's event on, is this listed, unlisted? Well, it's both. At Charter Hall, we're agnostic to the equity source. We very much believe that investors and their advisors will know their portfolios and their outcomes better than we would ever hope to or try to. So this part of today, I'll be introducing 4 Charter Hall speakers, and they'll run through the Charter Hall, which is the manager of all the listed vehicles and the business that I look after, the direct business. And then we're going to bring up 3 high-quality property professionals who run our listed stocks, and they're going to give you an overview on what drives their portfolios and the key attributes of each of those. So I'd like to welcome to the stage the Charter Hall presenters. The first speaker will be Russell Prout. Russell is Charter Hall's CFO, Chief Financial Officer, and is responsible for overseeing all the finance functions across the Charter Hall business. With over 25 years finance experience, Russell brings a breadth of knowledge from across commercial property markets, infrastructure, as well as private equity. Russell has a strong track record for managing extensive finance capability, both here in Australia and in international markets. Please welcome Russell.
Good morning, everybody, and thank you. And as Steve mentioned, my name is Russell Prout. I'm the CFO of Charter Hall Group. And just to clarify, the Charter Hall Group is the manager of the portfolio of the listed and unlisted businesses, our real estate investment funds throughout the portfolio, about $35 billion of value and about 800 properties in total. I've been with the group about 2 years, and I've been fortunate to be part of a period of tremendous growth and success. And today what I'll do is I'll take you through the group level business model and how we approach building that business, and then following that, my colleagues will take you through the 3 listed REITs. Now, turning to the first slide, just to give you an overview of Charter Hall at the group level, we currently manage, like I said, about $35 billion of assets under management. That's one of the largest managers of third-party capital in the direct property sector in the country. Our investments are primarily in Australia. We have some assets in New Zealand, but we continue to focus primarily in this country. Our success is really based on our ability to access capital. I think Steve used the word agnostic. We actually love all our children equally, whether that be listed, unlisted wholesale, unlisted direct. We also have a very good alignment of interests. We invest alongside our investors. We have about a $2 billion balance sheet that invests in most of our funds across all the strategies. And the key to our success is actually delivering returns. We can source the capital, we can source the transactions, but if we don't outperform, we will not be able to keep that business cycle alive. The one thing that scale does provide is access to transactions. So we've completed, in the last 5 years, approximately $20 billion of acquisitions and divestitures across the portfolio. And what that does is allows us to have tremendous market knowledge in the business and access to information and status of where the economy is from a leasing perspective, what investors are looking for, what returns look like, and where risk and opportunities exist in the market. On the next slide are a lot of numbers, but I would point out just 4 main areas. The first is, again, the scale. The scale of the business with 35 billion of assets. We have over 3,000 tenancies. So we have over 3,000 leases with tenants where we have a relationship, we house their businesses, we understand their business, and from there we extend other tenancies across office, industrial, and retail. We actually collect over 2 billion or approximately 2 billion of rent per year. Again, this provides tremendous insight into not just our portfolio, but the property market at large and the broader economy. And our focus, and if you look in the top right of that slide, the numbers are quite small, but our focus on really on property fundamentals. It sounds obvious, but high occupancy, long lease life, and high quality assets is a very good formula for success. So on average, our portfolio is about 98% occupied. We tend toward 100%, but can't quite get there across the entire portfolio. Our WALE, our weighted average lease expiry, so the length of our lease left in our tenancies is over 8 years at this point. So that provides a long period of contracted cash flows across our portfolio. And the cap rate is just under 6%, which shows a quality portfolio and a reflection of the assets across all of our funds. The other thing this slide does show in the middle pie chart or the middle circle is we invest across sectors. We're primarily office and industrial as the greater proportion, and as Bill pointed out, those are very good segments right now to be in. They have very good profiles from occupancy to basic economic backdrop. We also invest in retail in a very specialized area, and Greg will take you through that shortly, but it is primarily in the convenience part of the market, meaning that half our rents in our shopping centers come from grocery, the Kohl's and the Woolies of the world, and Aldi, as well as social infrastructure, which is a relatively new area, and Nick will take you through that shortly. And that is things like daycares. We have a very large portfolio of daycare centers. We have police stations. We have property related to other essential services, and we'll look to grow that area. The other area that's on that slide that I point you to is on the bottom left. It's the pie chart relating to how we source our capital. We source our capital from wholesale investors, that's super funds, international sovereign wealth funds, pension funds, as well as the listed market, as well as through direct investing with many of the people that are in the room today. Moving forward, and actually on the bottom right, sorry, before I move forward, on the bottom right, it shows the growth in the business since fiscal 14. Now, our strategy is actually quite straightforward and quite simple. We access capital, we deploy capital, we manage those portfolios of assets, and then we invest alongside. Those 4 elements of our strategy, or foundations of our strategy, actually have been very successful in allowing us to grow the business to 35 billion. As far as deploying capital, I think it's very important for people to understand that we don't just acquire assets, we also develop assets. We actually sell a lot of assets as well, so managing our portfolio to generate superior returns. And one element of our business, because we're all pretty financially oriented up here, that we probably aren't emphasizing a lot, but should, is among the nearly 600 people in our business, the greater proportion of them are property people. They're asset managers, they're property managers, they're leasing people. So they are actually managing the assets to make sure that occupancy and the WALE and the other aspects of the property value are maintained and optimized. And the detail underneath each of those 4 pillars on their 1 year, 3 year, and 5 years has shown the building and continued success in the business in generating returns and also growing the platform. Now, what this is translated into is a very impressive sustained period of growth in both earnings and distributions. The left-hand side shows the growth in earnings year on year since fiscal 14, and then on the right-hand side it shows the resulted distributions. In FY19 and guidance for FY20, we've indicated that we'll grow our distributions by 6% this year. That's actually well below our earnings growth, which this year was 25%, and we're guiding 18 to 20% in fiscal 20. The reason why we're holding back on the distributions a little bit is so we can reinvest in the business and drive future earnings. And then finally, these are the listed vehicles across the Charter Hall portfolio. The top group is the Charter Hall Group, which I've been speaking to. The ticker is CHC on the ASX, and is the manager of the entire business, and it speaks for the 35 billion, or manages the 35 billion portfolio underneath it. The other three REITs is what will be spoken to next, and they all have distinctive strategies, but are all focused around that same basic theory or basic strategy of long WALE, high occupancy, strong contracted cash flows over an extended period of time. So I said I'd keep it short and sweet. I think I'll hand it back to Steve now to introduce Greg.
Fantastic. Look, thanks for that, Russell. And look, the reason why we invited Russell here is because if you are looking at any manager, whether it's bonds, equities, or in this case, property, it's very important to understand who's managing the investments. At Charter Hall, we're all extremely aware that we're custodians for other people's money. It means we always need to act in the best interests of investors, and importantly, we need to deliver on what we say we will do in the offer documents, in presentations such as this. So look, now that Russell's set the scene for the group and the manager and how we like to focus on long-term leases, high occupancy, we're willing to sell assets where we think value's been maximised. I'll now invite Greg Chubb up to the stage. Greg is the CEO of the retail business at Charter Hall. He oversees the group's retail strategy across wholesale funds, property and asset management, leasing, marketing and development. He is also responsible for growing our convenience-based retail portfolio of shopping centres, hardware, so think Bunnings, hospitality and automotive assets. Greg leads the Charter Hall Retail REIT and has seen the value of the portfolio grow by 2.5 grow considerably over the last 5 years. Please welcome to the stage, Greg.
Good morning and thanks, Steve. I'll briefly introduce our ASX-listed REIT CQR. I'll go through our strategy, our portfolio summary, and key achievements that we recently reported to the market. So interestingly, CQR started life some 25 years ago as MCW, Macquarie Countrywide. And at that point in time, the fund owned a handful of supermarket-based retail in some pretty remote parts of Australia. So as the marketplace has changed, our portfolio has changed. People are shopping differently and people are living differently. So the portfolio over the last 25 years has changed dramatically. But one thing that hasn't changed is our focus on convenience. Our focus remains on being the leading owner and manager of convenience-based retail, predominantly driven by supermarkets and everyday needs. So I've got a team of 150 retail professionals that manage the day-to-day operations of the retail portfolio. And all of our team members are focused on making sure that the assets that we own and manage are the dominant convenience-based assets in their respective population catchments. And we achieve that through three very, very simple measures. We're an active manager, we focus on portfolio quality, and also we look at maintaining a very prudent capital position. Now, it's important to understand that retail has been under pressure, and as Bill's presentation pointed out, there's various parts of the retail sector that may well be in recession. But not all retail is the same. And it's our focus on supermarkets, convenience and everyday needs that places the CQR fund in a very good position. We have no department stores, Myers and David Jones in our portfolio, and we aren't exposed to the more volatile discretionary end of the retail spectrum, nor are we impacted by potential online threats. So it's a result of that strategy that we provide a secure and growing income stream for our investors. So if we look at our portfolio, as at the end of the financial year just recently completed, 58 centres across the country, worth about $3 billion across 640,000 square metres of tenantable area. So it's a very large and diverse national portfolio. Importantly, our centres are very productive, and we generated over $5 billion in retail sales over the last financial year from over 130 million customer or shopper visitations to our centres. So all of this generates a stable and growing rental income stream. We've got a very high occupancy rate across our portfolio of over 98%, and we grew our income stream by 2.1% over the last financial year. So I'll probably be a bit repetitive here, but I just want to get the message across in terms of where we focus. And our tenancy mix revolves around supermarkets as our major tenants, and then our smaller specialty tenants are focused around everyday needs, food, services. So it's a really, really simple and predictable tenancy mix. Our major tenants by names are the businesses that you'd all know very, very well: Coles, Woolworths, Aldi and Wesfarmers own businesses. And half of the income across the CQR fund is generated by those household names. Across our portfolio of 58 centres, we've got 75 supermarkets. 33 of them are Woolworths, 32 are Coles, and now 10 are with Aldi, and we continue to grow quite rapidly with Aldi. They're all very strong and well-run businesses, and they're all, very importantly, they're profitable. Our leases, very similar to what Russell spoke about, our focus is on the length of the leases with our major tenants, and we've managed our WALE, or our weighted average lease expiry, very actively over the last 4 years, and it's remained virtually unchanged at about 10.5 years with our major tenants. Look, the supermarket space in Australia is very, very strong businesses, lots of innovation at the customer level, and I'm sure you'd see that when you shop at your local supermarket on a very regular basis. And one of the strategies that we've unveiled with our supermarket operators in the last few years is that concept of click and collect. So you can shop various channels, and the aim of that is that we want to make sure that our supermarkets and our shopping centres are the most convenient in their catchments, and they're the most productive for our supermarket operators. And from a geographic perspective, we're very, very heavily weighted to the eastern seaboard, the key states of Queensland, New South Wales and Victoria, about 80% of our portfolio, and New South Wales ACT is our biggest at about 50%. So just in summary, I'll go through our key achievements that we reported to the market over the last few months for financial year 19. And it's our focus on supermarkets and the convenience end of the retail spectrum that's seen us to provide growth to our shareholders over the last year again. And all our major metrics for the portfolio are in growth. The portfolio itself grew by some 6.8% over the year to just under $3 billion, given our active asset management approach. We completed on 3 very high quality acquisitions over the period for some $275 million. At the same time, we were rotating properties out of the portfolio. Importantly, sales generated by our tenants remained strong. Our supermarkets grew at 4% over the financial year, and when we include our specialty tenants, that growth was 2.8%. And the very important measure of footfall through our centres, so customer traffic, grew by 1.8% over the period. So this all led to income growth of 2.1% and distribution growth to our shareholders of 2%. Now, CQR is a very attractive yielding stock, and today is trading at about a 7% operating earnings yield and a high 6% distribution yield to our shareholders. And it's that focus on supermarkets, Australia's major supermarkets, and convenience-based everyday needs that's driving that stability and predictability of our earnings. So in closing, when you're thinking about retail, just remember that not all retail is created equally, and it's the focus on convenience, supermarkets and everyday needs that sets the CQR fund apart. Thank you for your time this morning.
Well, look, thanks for that, Greg, and you actually stole my line that you do need to look below the hood of things. You need to do research, and it's very easy to get caught up in some of the headwinds of retail, but as Greg just said, the area that we're focused on is that non-discretionary retail side. So with that, I'd now welcome up to the lectern Avi Anger, who's the fund manager of the listed Charter Hall Long WALE REIT. Avi joined Charter Hall in 2003, so around 16 years at the group. Prior to his current role, Avi was head of transactions and advisory and was responsible for all the property transactions of the group and its managed funds. Avi's played a key role in the growth of the group's funds under management from approximately $3 billion back in 2009 to where it is today. Please welcome to the stage, Avi.
Thanks, everyone. Thanks, Steve. I've just been asked to speak for 3 minutes today, so I'm going to try and give you the 3-minute version of the Long WALE REIT. WALE, for those, it's nothing to do with animals in the ocean. It stands for weighted average lease expiry. Our fund focuses on properties that have long leases. So we're a real estate investment trust listed on the Australian Stock Exchange. We aim to provide investors with stable and secure income and the potential for both income and capital growth through an exposure to properties with long leases. If I turn to the next slide. Our portfolio features 156 properties at $2.5 billion of asset value. We have long-dated leases across our portfolio, with the average lease term being 13.2 years. We have close to 100% occupancy and a very diverse portfolio across property types. We own office, industrial, retail, agri-logistics, and 37 telephone exchanges that we bought from Telstra about a month ago. We have a portfolio that's predominantly leased to government and ASX listed and multinational tenants. All our leases have increases in them, so the rent goes up every year, and we have a mix of both CPI and fixed increases. The average increase in the last year was 2.8%. So we have leases that have income growing in them year on year, and that long lease profile, long lease expiry profile, means that we have that continued growth year on year for quite some time. And we're a top 200 ASX listed entity. What sets us apart from other property funds is the quality of the tenants in our portfolio. So our tenants feature the likes of Woolworths and Coles. So 46% of our portfolio's ASX listed food, grocery. So it's groups like Woolworths and Coles, where we own a number of distribution centres for Woolworths and Coles, which service their supermarkets nationally. Close to 20% of our portfolio is leased to government. And the balance is made up of some other very high quality ASX listed and multinational tenants, the likes of Telstra, Westpac, Suez Group, which is an $8 billion French recycling business, and Toll. Importantly, our tenants are predominantly non-discretionary, which means that they are going to operate through economic cycles. They're large, well-known businesses, and even if we enter a downturn, these businesses are very resilient, and whilst their profitability may reduce, they're going to perform through cycles, and that's really important to us in providing that continuity of income to our investors. Another unique feature of this REIT is its long leases, hence the name, the Long WALE REIT. Our average lease is 13.2 years, and as you can see on that graph, we have very little expiring in the next 5 years. And what this means, as I mentioned earlier, is we're able to deliver that stable and secure income year on year that is growing year on year in line with the rent increases that we have in all our leases. So I often get asked the question, how do you maintain a long lease expiry profile across your portfolio? We do this in mainly two ways. We actively work with tenants to extend leases, and we've done that a number of times in our portfolio over the last 12 months, and also through acquisition. As I mentioned, we purchased a portfolio of 21 telephone exchanges leased to Telstra, and the average lease across that portfolio was 21 years. So look, that's a brief overview of Long WALE REIT. I'm happy to take any questions after the presentation. I'll be around, as will other members of Charter Hall staff, and thanks for your time today.
Thanks for that update, Avi. And look, Avi was quite modest there. The performance of that listed vehicle has been nothing short of spectacular in the last 12 months, and it's a real testament to himself and the wider team of the Long WALE REIT in that aspect. Our final fund manager of the listed part is Nick Agnostou. He's head of Charter Hall's social infrastructure funds, and Nick joined Charter Hall last year as part of Charter Hall's acquisition of the Folkestone Group, which he joined back in 2006. Nick is an executive board member of the ASX-listed Charter Hall Education Trust and the Charter Hall CIB Fund. Nick has more than 25 years' experience in the Australian commercial property and funds management industries. Please welcome to the stage, Nick.
Good morning, everybody, and thanks for your attention today. I will follow on from a number of the themes that you've probably already heard from Russell, Greg and Avi around Long WALE, but hopefully what you'll also see in our presentation today is a lot of the themes that may have come out of Bill's earlier discussion around the economy and some of the key things that we're facing as an economy looking forward, particularly around things like wages growth, population growth and other things, and you'll see the importance of social infrastructure in that context. The Charter Hall Education Trust is an ASX 300 listed property trust. We have 422 properties across Australia, including 40 in New Zealand. Social infrastructure can be otherwise defined, investable social infrastructure assets can be defined as real estate assets that, along with providing a commercial level of return to their investors, provide a social as well as economic benefit back to their communities through the provision of essential services or services that support employment, well-being, education and social cohesion. Social infrastructure assets include things such as childcare facilities, schools, police stations, courthouses and network public transport facilities, amongst others, that have traditionally been provided by governments or may now receive government funding as a support mechanism for private industry's involvement. CQE was established in 2003. It has a successful track record and its learnings from childcare have seen it take what is a highly successful investment formula and, where possible, replicate it across a wider range of social infrastructure assets. An overview of CQE is that it's got gross assets of 1.2 billion, a geographically diverse 422 properties across Australia and New Zealand. Long-term leases provide a weighted average lease term of approximately 10 years and a property yield of 6.2%. We're 100% occupied as at the 30th of June 2019, and importantly, the Charter Hall Group has a co-investment alongside its investors of $119 million. For today's illustration, I'll focus just on childcare and the formula that differentiates CQE from its peers and that which has been so successful to date. We've broken this slide up into three components. The left-hand side characterises the key attributes of childcare and why it's so important to the Australian economy. It really is the perfect example of a social infrastructure asset that provides both community as well as economic benefits. The need to educate our next generation of Australians in an international sense is where Australia's education system has actually fallen well behind its peers, and we need to support an ageing population with a greater number of tax-paying and productive workers make up the two major planks of the government's commitment to childcare. So firstly is education. The second part is actually it is a labour supply mechanism that allows the economy to put one more person into the workforce. The key issue that Australia faces at the moment is, particularly with respect to jobs, at 5.2% unemployment rate, it is incrementally harder to get one more person into the workforce than if you had an unemployment rate of 10%. And typically the greatest barrier to entry at this point in time is actually people looking after their children and the provision of childcare. The key characteristics for us, really, and the things that we are focusing on are population growth, the demographics, and certainly also economic activity. There's strong latent demand, and that's driven by population growth, an increasing female workforce participation rate, which is now at an all-time high of 61%, historically high levels of females with professional qualifications, and the need for greater productivity in the workforce. Government's recognition of childcare is quite simple. It actually pays for itself. For every dollar, the studies have shown in the past, for every dollar the government spends on childcare, they expect to get back about $1.80 in taxes by virtue of typically mum, becoming a taxpayer once she returns back into the workforce. The lack of substitutionality of childcare is important. You can't buy a virtual childcare place online. You have to physically take your child, put them into a centre, and then go and pick them up that afternoon and bring them back. The imperative is that essentially for families with children under the age of 12, 48% of all families are now a dual income family, and that's simply driven by the cost of mortgages and real estate, the cost of living, and particularly if you're aspirational and may want to send your children to a private school or those sorts of activities, you are now a dual income family. Just moving to the right-hand side, to the third column, to operate in the environment that we do, or the environment that childcare does, it's highly regulated, and tenants do require long-term leases. They're unable to pick up their premises or unable to pick up their businesses and simply move it somewhere else. And the reason for that is parents don't like that, and the regulatory environment around the premises themselves are very, very tight. That underpins, so what they need in order to underpin the goodwill value of their business is a long-term lease. So typically CQE is able to offer a 15-year lease. A 15-year lease moving forward. We have a no incentive environment. We also have a net effective rents, so that the rent that you are getting is actually true rent as opposed to a face rent, which is elevated by virtue of a capital contribution back to back to tenants. One of the key features of CQE that differentiated is that we're about 60% land value. And in that 60% of land value, if land values typically tend to double every 7 to 10 years, which historically we've seen that happen in Australia and worldwide, we're in a pretty solid position at the end of a lease term to be able to pick up some upside. And that's where we pick up on the population growth thematic and certainly the economic activity thematic, because simply our governments and our state governments can't afford to let our suburban boundaries continue to grow, so they release density. Density is good for population growth, it's good for childcare, and ultimately it's good for land value at the same time. Just conscious of time, I'll just simply turn to our performance over the last 5 years. CQE's delivered distribution growth since 2010. Over the last 5 years, that's been about 6% per annum. At the same time, we've delivered capital growth, and that's also mimicked about 6% per annum over a period of time. CQE is a very simple business model. We have 100% occupancy, and if we can maintain that. We have triple net leases, and triple net leases are essentially those leases where the tenant is responsible for payment of all expenses, including those of a capital nature. So there's very, very little leakage. I think last year we had $200,000 worth of expenditure on a $1.2 billion portfolio. It's those aspects that actually we think are the key drivers behind our investment performance. Certainly not having any vacancy, not having to pay out incentives, and the triple net lease structure are things that really are attractive for investors in the long term. CQE is a vehicle which should, subject to obviously market conditions and cost of debt and those sorts of things, be able to provide a very predictable and visible income projection for investors on the way into the future, and that's certainly been the case to date, and much to the benefit of our existing investors. Thank you for your time today.
Look, thanks, Nick. That's really helpful to be able to understand the drivers of the social infrastructure piece in the property space. And look, that brings me to today's last speaker. For whatever my sins, it's me. And what I'll be doing is, you've just heard from our high-quality listed team. I'm going to walk you through the unlisted part of the business. So the first thing I'd say is, look, I said this at the start, but it is very important to understand that nothing we've talked about today is financial advice. If you are interested in anything we've talked about, I do encourage you to always do your own research and speak to an advisor if you have one. And look, I might as well kick off. What is unlisted property? Well, very simply, unlisted, not traded on a stock exchange. Because it's not traded on a stock exchange, what sets the unit prices? Well, the unit prices are simply driven by independent valuations. That means on a 6-monthly basis, we will go to the market, bring in high-quality external valuers, and they'll value every asset in our fund, and that sets the unit price. Unlike the listed market, where it moves up and down based on what's happening in the equities world. We have monthly or quarterly distributions. Look, that's extremely important in the current low yield environment. We know from speaking to a lot of investors, a lot of these functions, many people invest with us because they need the income, they need that regularity, and depending on the fund which we're talking about, we either do monthly or quarterly is the furthest frequency have. But importantly, what isn't unlisted property? It doesn't mean you're getting a lower quality asset. It means you're still focused on that institutional space, the highest quality assets, regardless of the equity source. And interestingly, unlisted property brings a number of benefits overall to an investor's portfolio. Without getting into the actual numbers, unlisted direct property has a much lower correlation to other key investment classes such as bonds and equities, and has lower volatility than listed property and the markets generally. So what do we do at Charter Hall Direct? Well, our value proposition is very simple. We want to provide regular and stable growing income streams and the potential for capital growth. You've heard from our earlier speakers. At Charter Hall, we know what we do well, and we like to keep things simple. That's long-term leases, high occupancy rates, and we focus on the tenant covenant. So who's paying the rent on those leases? And I'll give you some examples, and I'm fortunate I've got a few videos, so you don't need to listen to me for the whole time as well. We've got over 13,700 investors. That's unique investors across the book. If you were to look at all the investors that have multiple investments with us, the number's closer to 20,000 separate accounts. And look, we do get all our products externally researched, and we've won numerous industry awards, which the team's very proud of. Part of the reason for that is they benchmark us against other products in the market and what we've been able to deliver and achieve for our investor base. So performance, and it comes with that old caveat, past performance isn't a reliable indicator, but it is important to understand, if this is a sector you're considering, what the manager has done in this space over a long period of time. So these returns you can see here are up over the last 18 years. So I've been here close to 10 years, so prior to my time. All the funds you can see there, the light grey is the benchmark. The dark grey is simply funds that we've opened, raised equity for, and returned money to and shut the funds. The middle section are funds that are no longer open to new investment, but we're still managing the portfolio. And the ones there in the dark blue are the funds that are currently open for investment. Look, it's important to point out where we didn't get it right. I don't want to sit up here and say everything always goes exactly to plan. There's probably 2 syndicates in that grey section that were based in Perth, where the returns weren't as high as we would have liked. They still generated a total return of 7% at least. And it's important to understand what happened in that market during the time. So since those products were launched, the rents in the office market in Perth fell 50%. So just think about that. The rents fell 50%, and yet we're still able to generate that strong return. The reason is because the group's strategy of long-term leases really insulated those assets from that downturn. The long leases mean you're never forced to sell assets at points in the cycle where you don't want to sell them. It means you're never forced to negotiate with tenants around vacancies and when rents have come off. It means we just sat tight, we waited for the market to turn, and as things have picked up, we then moved on and we sold the asset once the market had turned. But as you can see here, by and large, we've had a fantastic result, beating benchmarks on average around 3% over a very long period of time. And this chart is probably my favourite chart of anything I'm going to talk about. Not because it tells you anything absolutely amazing, but because the message is so simple. This is office unlisted property. And what you can see here is the blue bar. The blue bar is the income return each year for a 20-year period. So what you can see here is the grey is the capital appreciation, and you can see there the GFC, the asset class did come off, as did everything else. The black line being the total return, the summation of the income and the capital. But what you can see there, and I hope one thing you take away from everything I've spoken about here today, is the regularity and consistency of the income return. And for many investors, that importance has only increased over time when you're looking at term deposits, cash, which do have different risk profiles, but it's very difficult to live off those in the current environment. And so now I'm just going to take a little break. I'm quite fortunate in that I'm not talking about a bond or a derivative or something as abstract as that. We're talking about real property. So this is a short 3-minute video on Western Sydney University's campus out at Parramatta. We secured it working with our partners on a 15-year lease, fantastic tenant covenant, and it means because it's a new property, the capital expenditure or CapEx is extremely low, meaning as you just heard from Nick, low CapEx is great and means more money that gets passed through to our investors. So you will hear a bit of a voiceover from the Premier here, and it's good to see that the government is very focused on Parramatta. For those that aren't aware, and it's very easy to miss this if you're living in the eastern suburbs, North Shore, even where we are today, Martin Place, but Parramatta is the geographic centre, population centre of Sydney. If you drew a circle around Parramatta, you'll find that's the middle. And what you're seeing is more and more tenants are going out there because not only are the rents cheaper, around half of what they are in the CBD, but it's closer to their staff and it's where their people want to work.
We have here a world-class facility, which if I had my time again would be my first choice of where to study. We will see thousands of students come through these wonderful learning environments and provide our future leadership of our state and our nation.
One Parramatta Square is one of Western Sydney University's most important strategic initiatives. It's the most important project that we've undertaken in the last decade. It's a step for the university to move into the heart of Sydney by placing a vertical campus right in the heart of Parramatta.
We, some years ago, decided to take a strategic approach to really understanding the education sector. It's been a wonderful journey for our team to understand what really drives a university, particularly one like WSU that's trying to create vertical campuses and something that's going to connect their students much more to corporate life.
This is the most technologically advanced building in an Australian university, and I think it would stand up internationally. And we have infused technology right through this building.
The technology in this building is really great because it allows the students to have a really collaborative environment in classrooms, especially the screen sharing option that we have.
With technology all around, you have lecturers facilitating learning in a flipped classroom, and that's an innovation that we're very, very pleased to be bringing to Parramatta ahead of many other universities in Australia.
To have teaching spaces and hubs where lecturers and students can interact, where you can work as teams, it's a tremendous building. And we know already the feedback we're getting both from the lecturers but also from the students is really positive.
What I really like about this campus is the collaborative spaces that it provides. So it gives us the opportunity to book our own rooms to work on assignments with our group members, and also it has a really quiet environment that no other campus can provide with all its study booths.
Every level has a space or spaces for you to study, whether that be by yourself or with a group of people. It really motivates me to want to study and want to be at uni as well.
This is a great partnership with Charter Hall, a wonderful opportunity for us to be the tenant in this building.
It's been fantastic for us to deliver it on time, on budget, and to create a world-class facility. It's also a showcase. We've started speaking to a whole range of other education organisations, and I think we will see this as being the first of a number of investments the Charter Hall Group make in the education sector.
What I especially love is that this will be the heartbeat of a precinct where we will see businesses come in, where we will see integrated facilities, which means we're not just creating a learning environment here, but an entire new vibrant community. I feel extremely inspired, and may this building inspire thousands of others to reach their full potential into the future.
Slide and video didn't actually show, which I think is another key advantage of what Charter Hall brings. And remember, the business that myself and the team look after delivers that institutional quality property to retail investors, self-managed super funds and high net wealth investors. But in this case, we actually teamed up with our large wholesale office fund. So it meant the retail investors are investing in exactly the same assets, but you didn't need a $10 or $20 million check, which you need to access that wholesale fund. So it's about providing that highest quality institutional grade property to our investors. And to that end, it's worthwhile just running through 3 examples of some of our most recent transactions and how we put together deals for the portfolios that we manage. So the first asset there is Mary Street up in Brisbane. It's a large asset, as you can see, over $250 million. But what did we like about it? Well, the prior owner spent over $40 million fully upgrading that, meaning, again, the capital expenditure requirement's low. And look who the tenant is. Not only does it have a 10-year lease term, but it's the Queensland Government. We talked about the strength of the income covenant being critical, and it is absolutely essential because a 10-year lease is only as good as the person or entity who's paying that rent. And someone said to me the other day, well, Stephen, what happens if the government stops paying the rent? And I said, well, who cares, to be honest? The returns of this fund will be the last thing you're worrying about if the government weren't paying the rent. But it's such a ridiculous question to focus on that. We're one of the few AAA-rated countries in the world. The middle investment is the main freight industrial asset, which we recently developed. When I say developed, it's important to realise we didn't take on that development and construction risk. We had a binding long-term lease in place before we signed a single thing acquiring that property. So for industrial property, you've all heard about e-commerce, you've all heard about some of the challenges that your David Jones and Myers have. You need to think about flipping it around. The challenges for Myer and DJs, they're a real strength for the industrial property market. So every time someone clicks on a keypad or flicks on an iPhone and orders something, a whole series of events happen, and they're typically triggered at industrial and distribution facilities. And again, this tenant, Mainfreight, a $4 billion New Zealand market cap, a brand new facility close to the M7, M5, and that infrastructure linkage critical to the industrial assets. And finally, the asset, Shelley Street, again, we partnered up with our wholesale fund. So the value of that asset there, $260 million, is our 50% interest. So not only does it mean we get the highest quality, it means we get access to properties that would otherwise be too large, too much tenant concentration, too much geographic concentration, even for the $2 billion fund, the direct office fund which purchased it. So by being able to partner up with our wholesale vehicles, it means we get a much better portfolio construction and a better result for our investors. And so I might just use the direct office fund as a little bit of an example. It is our flagship fund, over $2 billion. I think it was Nick said before, we like things pretty boring and simple. Occupancy rate, 99%. Long-term leases, 8.6 years. Quarterly distributions, and the returns have been extremely strong over a long period of time. It is important to realise the returns, you shouldn't expect that going forward. In fact, I never tell people what to expect. All I can say is that at Charter Hall we take as many of the known risks out of portfolios as we can, and that comes from long-term leases, high occupancy, the covenant strength, gearing. Charter Hall, we typically have a gearing range across the suite of funds somewhere between 20 and 45%. We could increase the distribution rates on every one of the funds we manage simply by putting more debt into the vehicle. But we don't do that because at Charter Hall we're very focused on the risk-adjusted returns. So that is the return that's delivered from a given amount of risk that you put in. And gearing can amplify the returns, but it does amplify the risk. So if you are looking at this investment class, whether it's listed, unlisted, I always encourage people to look at the gearing that the manager has and for you to decide whether you think that's a prudent level. The weighting of this fund, 92% Eastern Seaboard, not an accident. 2/3 are Sydney, Melbourne, the two largest office markets, and we've recently pivoted the portfolio weighting to the Brisbane market where we believe there's simply better value to be had. That asset which we just talked about, Mary Street up in Queensland, 10-year lease to the government, 6% capitalisation rate. I can tell you if that was in Sydney or Melbourne, that capitalisation rate for a government tenant of that term would be below 5%. So you need to make sure you curate the portfolio to deliver that regular and growing income stream. And the tenants, as I said already, 29% of the portfolio is government, so that's federal or state. But even outside of these tenant covenants, you need to look at groups like Suncorp, Coles, Westpac. We heard from Bill Evans. They're a key tenant. We have one of their properties and we actually own that asset, again, 50-50 joint venture with the Long WALE REIT. So again, it's about spreading the portfolio risk amongst the various vehicles. So these are our largest tenants. And again, it's not an accident that we end up with these tenants in the portfolio. The group works extremely hard through the asset management and property management teams, which we have located throughout the whole country, to develop these portfolios in the way that we do. And something that is a little bit unusual about Australian commercial property, so that's regardless of the sector and sets it apart, is that we benefit typically from fixed rental increases that mean the rent increases year on year. So for a fund like the Direct Office Fund, it's 3.6%. But just for maths, if we assume it's 3.5%, it means if I'm a tenant in this portfolio, on average, I pay $100 year one. Year two, I'm paying $103.50. Year three, $107.12, $110.82, and so on. It's got built-in compounding, which simply means that the distribution rate's able to increase over time for the benefit of the investors. Our PFA fund, look, it's slightly smaller. It focuses more on CBD and emerging markets. It has monthly distributions. We actually took this fund over from another manager in excess of 5 years ago. Took us a long time to bring that portfolio up to a position where we wanted to reopen it to new equity. We reduced the gearing, we simplified the strategy, and we focused on all the things we've talked about today. The industrial fund. Our marketing is good at Charter Hall, but to be honest, it's not something we've particularly focused on, and you can see that in the fact it's called the Charter Hall Direct Industrial Fund number 4. No guesses that it 3 more came before it, but the reason why we've continued to do this, it's a series investors know well. It's a sector that we were first to make this option available to high net wealth and retail investors back in 2010. We think the sector thematically has a lot of tailwinds going for it, and being able to provide a pure play unlisted exposure to this particular sector, we think is a real opportunity that isn't always made available to retail investors. So with industrial assets, you typically get a longer term lease, so a little over 10 years here, 100% occupancy. You can see it's a little bit boring, isn't it? We're talking about the same thing. But it is good to be simple on the strategy. It means it's clear to the team and it's clear to the investors how we execute it. And I'll just show you a video of the main freight facility, which is owned by Diff 4. Many people, when you hear industrial or logistics, think dirty warehousing, plastics, steel, manufacturing. It couldn't be further from where the trend is going around industrial and logistics assets. You can see how high the clearance is. You want in industrial property high clearance, meaning that it's useful for more and more tenants. You've got that flexibility. Again, it's a new asset, low capital expenditure. It's a huge facility. And importantly, it's only 2 minutes off the M7 and it's 5 minutes away from the M5. What people don't realise with industrial property is that, yes, rent is important. Rent's always important to tenants, but the kilometre cost to move goods is much more important for a group like Main Freight, who are effectively a distribution business. One of our distribution team members, whenever he's around the country, always tells me, I saw another Main Freight truck. And once you see these kind of tenants in the portfolio, you do notice them all around. So you can see here, very different proposition industrial now to what industrial looked like 20 years ago. And finally, we have created a diversified fund. We had some feedback from investors that they didn't know whether they wanted office or industrial. So what we've done here, whilst it's diversified, it focuses still on a unifying theme around consumer staples. What are consumer staples? Well, put simply, they're goods that people tend to buy regardless of their position. Fuel, medical, food, these sort of things. And again, it's the smallest portfolio we have. It's the most recent product. And what you'll see over time is that that fund will continue to grow and diversify, and it offers investors monthly distribution. So that brings me to the end. I've put this up. This is the direct team. Many of them are standing at the back of the room. I do encourage you, if you have any questions, please do ask them. They're very helpful. They're very knowledgeable. The team's been together for a long period of time. And I'd also encourage you, the listed fund managers will be down here towards the front of the room. If you have questions, they are available. Please do go up and ask. If there's something that's burning desire, just ask them. They're very happy to help. And for myself, on behalf of all of Charter Hall, I would like to thank you all for taking the time out of your busy schedules, for being with us today. I hope you've been able to learn something. As I said, this is meant to be an educational piece, understanding the markets, how Charter Hall does things. So with that, thank you very much and have a nice day.